So good afternoon, everyone. Today our topic will be international trade and finance. So when you talk about international trade, that no country of the world is actually self-dependent. They will have to actually take help from other countries. They are depending on other countries for various reasons. It could be for raw materials, for capital goods, a lot of reasons they will be depending on other countries because not every country has all the resources to actually produce their goods and services they need. So even you can think this way, like, for example, a country has a less population and they need labor. They can use the other country labor from other countries as well. So it depends on what do they need. And most of the countries, they actually make trade with each other. Okay, the trade is one of the most visible aspects of globalization of the modern world. So as major global traders are China, India, US, and Japan. That's the major global traders with Australia actually. Australia's top 10 two-way trading partners, two-way trading. So two-way trading actually. So is the China, Japan, USA, Korea, they mean Republic of Korea, which is actually South Korea, they mean, the Singapore, New Zealand, then UK, Thailand, Malaysia, Germany. So these are the various countries that Australia has two-way trading terms, okay? So why do they, as I said before, modern economies are interdependent on each other through for what reasons? Trade in goods and services, for financing reasons, global geopolitics and economic policies as well, okay? Trade is also linked to globalization of production and globalization of labor in a smaller scale, like I said before. So if there is like globalization, when the globalization started in 1980s, that's the time they started the globalization. And it's actually like they opened the door to all the countries, open their door to each other. They can actually freely, they can actually trade, but there are some taxes they impose. But at the same time, you cannot say that every country has a free trade. They can trade anything they want to each other countries. It's not like that exactly. Okay, so every country, they have some restrictions. They put taxes. Like you, I think you guys have must heard that in the USA has put lots of taxes on Chinese product, and China also put taxes on American product. They have these things. In Australia, currently is going through a really a bad diplomatic relationship with China, and it actually have impact on their business too. It is important have a good diplomatic relationship with all the countries of the world. Okay, so the case relating concepts, production possibility, frontier, and opportunity cost with international trade. So when you talk about international trade itself has a different subject. Like if any of you have tried, I teach international trade in some other university, and international trade itself is a big chapter to talk about. What are the model they use, different types of models they have, which country to deal with which product, and why that country will be producing one product, why is other country not producing another product. So there is a long discussion. I'm not going to talk about international trade today, but I will give you a very brief discussion about these things. Okay, so they say opportunity cost in international trade is like this: in choosing among feasible output combinations, people face opportunities cost. Opportunity cost of any action is the best alternative for gone. We know these things. So when a country, like, let's go, they didn't talk in here these things. So like, for example, let's say that Australia wants to actually produce more of let's say some items. Let's say Australia produces cattle, and they have produced lots of beef, for example. When they need to supply beef to China, Australia is a huge supplier of beef to Middle East, and also the huge supplier of beef to China as well. A lot of things, lot of product they supply to different countries. So if they want to increase the production of beef, Australia will have to make sacrifice on other product, because every country, as we know before, that every country, they have their limitations of how much they can produce using their resources. Okay, so from that point of view, yes, if a country think that we are going to actually increase the production of one item, they will have opportunity cost of producing that item, because they have to actually sacrifice the production of other items. So that's from that point of view, they're talking these things. Okay. Now here is a GDP growth in worldwide GDP growth. So you can see here GDP growth has fallen down in 2008. That's the time 8, 9, and 10. This is the time that globally we had these issues from the global financial crisis. And GDP growth in China and India, you can see that. The China is the red one. There also GDP falling down. Then India also GDP dropped. So most of the countries during like here, advanced, okay, Euro area, USA, Japan, or most of the countries, they had the GDP drop in 2008-9 because of the global financial crisis. Okay, and this another graph is in here. Today I will go very fast on this chapter because I have an intention to talk to you about exam paper as well, exam revisions as well. We'll talk about that too today a little bit. So that's why I'll go a little bit fast. So future annual growth in volume of world exports and GDP. So you see the export, when your GDP and export is related to each other. You can see here, there is a good relationship between GDP and export. So here you can see that the year is shown on the x-axis and the annual percentage of change is shown on the y-axis. So this is actually change, percentage of change. So that's why you can see the data looks like a stationary data. That's how they looks like in here. And you can see here the relationship, they have a long run relationship, that they are co-integrated. I can see that very clearly. So when the GDP has fallen down, you can see the export also dropped. When the GDP is going high, the GDP is going high, you will see the export is also going high. Okay, so that's what they're trying to show here. Exports by product, which country is producing what? So you can see here, this is the thing. I think Saudi Arabia is in here. They are actually, it looks like, let me make it bigger. 87% of global petroleum, you can see here, crude oils coming from here. Then in Europe as well, some crude oil, car. Then here, this is, what is this? I think it's the capital goods they mean here, the chemicals. Okay, so different countries are actually expert in producing different items. Australia also has, like here, crude oil, the 7% of these, and okay, this wheat is there. This is wheat. Yeah. So they try to show you here that what are the countries, what export by product in 2012. Okay, so which country was producing what? That's what they try to show in here. Okay, global welfare and trade. Trade theories stem from the concept of a specialization in production, which is facilitated by absolute advantage, comparative advantage, two different things. David Ricardo has a model in international trade called Ricardo model. They have a model of Ricardo in international trade. When you do that subject, they will teach you this one, David Ricardo model. Adam Smith has talked about absolute advantage. So what is absolute advantage and what is comparative advantage? I will talk a little bit in here, not much. Okay, so specialization, let's talk about specialization a little bit. Specialization means when a country is expert in producing one item, they become specialized in that specific item. For example, France is very specialized in producing wine. Europe, Germany, automobiles. Japan, electronics, like this. Like China, consumer goods. Their expertise in these things. Okay, so that's called specialization. When they produce one item for a long time, they become specialized on that item. So what absolute advantage means? Absolute advantage means it is comparison of the productivity of one person, farm or nation with that of another person. When you compare two items, two things, either a country or a farm or a person, when you compare these two things, when one country is actually expert, actually has a higher productivity than another country, that's what is called an absolute advantage. So a country has an absolute advantage over another country in production of goods if it can produce it at a lower cost. That's the whole point. If they produce it at a lower cost. But comparative advantage is not about costing, it's about opportunity costing. He says in the comparison of among individuals, firms, and nations according to their opportunity cost. So these things is not about lowering the cost, production cost, is about the opportunity cost. They need to, if a country wants to increase their production, what will be the opportunity cost compared to the other country? So when they compare this opportunity cost, that becomes the comparative advantage. And absolute advantage is when they have lower production cost than another country, that's called the absolute advantage. So remember this thing. So each one is at lower cost. The country they have a lower cost, that's another one is the opportunity cost. And his comparative advantage and imported product in his comparative advantage. So it's on the opportunity cost basis, based on the opportunity cost. Okay, so that's the difference between absolute advantage and comparative advantage. Okay, so and there's terms of trade. Terms of trade is actually average price of export divided by average price of import. That's called terms of trade. Okay, this is a formula that we use to see which country you can actually import the goods from. So you can see here Australian terms of trade is actually dropping. So when you go here, average price of export divided by average price of import. So if it is dropping, okay, so it means that average price of export is lower than the average price of import. Okay, in Australia, average terms of trade is actually lowering. Okay, gain from trade. For let's say they say here production possibility of two countries. Okay, so less developing country and developed country. Less developing country, LDC country, we call that LDC, less developed country and the developed countries. Okay, so less developed country can kilos of wheat, they can produce 2 kilos of wheat, or they can produce 1 meter of cloth. Okay, developed country, they can produce 4 kilos of wheat, or they can produce 8 meters of cloth. So pre-trade exchange ratios, what the exchange ratio they have? Now less developed country, the 2 wheat for 1 cloth for less developed countries. So if they look, they can produce, less developed countries, they can produce 2 kilos of wheat, or they can produce 1 meter of cloth. Okay, so 2 kilos of wheat or 1 meter of cloth. So they say 2 wheat for 1 cloth. That's their ratio of production. They can produce, if they want to produce 1 meter of cloth, they have to sacrifice 2 kilo of wheat. That's how they mean. For developed countries, you look at here, 4 and 8, other way around. 1 wheat for 2 clothes. In developed countries, if they want to produce 1 meter of cloth, they have to sacrifice half kilo of wheat. Okay, so this is the thing. You can see the ratios are in here. So they will see that now 1 cloth, there's developed countries, they will sacrifice 2 kilo of wheat, and for developed countries, 1 meter of cloth, they have to sacrifice half kilo of wheat, right? So developed country have to sacrifice less wheat to produce 1 meter of cloth. So developed country will be actually producing cloth then, we can see, because they will have to sacrifice less. Okay, so developed country is expert in producing cloth. Okay, that's what we can see here. So that's what they will talk in here anyway. Okay, so that's what the LDC country has to give up 1 kilo of wheat to obtain 1 meter of cloth, where is okay. Yes. So after this, what they're doing? After that, they're actually now doing international trade. They're doing. What international trade they're doing? They have decided, they will decide, look, this is the pre-trade exchange ratios they have. 2 wheat, 1 cloth, 1 wheat, 2 cloth. This is the situation they have. So they will make the trade in such a way that they will find 1 wheat for 1 cloth, 1 wheat for 1 cloth. That's the situation they will come. How they gonna do these things? They will decide, okay, less developed country will be producing wheat, developed country will be producing cloth, and they will exchange. They will export and import. So when the developed country is expert in producing cloth, they will be producing more cloth. For whom? For developed country and also for less developing country. And they will make a contract. Okay, less developed country, you are going to produce wheat only because you are expert in producing wheat. Okay, so less developing country will be producing wheat for themselves and also for the developed country. And then they will exchange the goods. Okay, that's how they will get these things. Okay. So they will give, okay, I give you 1 kilo of wheat, you give me 1 kilo of cloth. That's how they will go to the exchange. Okay. How do they get these competitive advantages? For a lot of reasons they can get it. For individual reasons like inborn talent, education and training, experience, specialization in competitive advantage, reinforce itself over time. So individual level, that's how people receive their specialization. Some people are born talented person by born talent. Some people they have, for individual you're talking about, that's what you're talking about, people only. Education and they have better education, better training, they become specialized. Okay. For national way, country-wise, well, natural resources is very important here. Natural resources endowment, Australia has easy access to ores and minerals. Australia has lots of these things, so they are expert in producing ores. So China will be purchasing ore from Australia. But recently they had a little bit hiccup in their relationship. So China said, no, we're not going to buy it from you. So yes, it's like It happens in politics, international politics, it happens, okay? It happens. Let's not talk about the regions of politics things right now. Yeah. Then they have infrastructure, research and development, subsidies. So a lot of things will be coming up here. Some countries, they spend a lot of money in research and development, but you will see some countries do not have enough money to invest in research and development. Okay. The cultural institutions and education system plus entrepreneurial spirit. So these are the things they can have a specialization about. All right. Free trade. Okay. What is free trade? This says free trade refers to the trade between nations that is not restricted by government protection of domestic industries. Free trade between nations is said to increase world output. So when they have free trade, it means that countries can buy and sell goods, one export and import from one country to another country without any restrictions. That's what we mean the free trade. But well, that's the theory, right? In real life, in realistic way, not necessarily we have free trade. Countries they will try to find out some other way if they find that their country needs to develop more or their country have some problems in their employment situations. Okay. All right. Trade restriction and protection, so that's what comes up. Free trade is not free all the time. There are always some restrictions and protectionism is involved. Is government measures designed to protect domestic industries from competition by international firms and industries. So yes, like let's say if one country just let the other country produce everything, they will never be able to produce one item. For example, in our examples, we said wheat and cloth. So if developed country let the less developing country produce wheat all the time, that less developing country also will only be expert in agriculture industry, but they will not be able to go in manufacturing, which is clothing. So less developing country will slowly try to, they will think, okay, well, we are not going to keep our life only on agricultural industry. We want to actually develop ourselves. They will go for manufacturing as well slowly. So when they start to set up clothing companies, manufacturing of clothes in their countries, they will actually put a restriction on importing clothes from other developed countries. How they're going to do it? Taxes. They do it by putting some taxes, embargoes, quota, a lot of things they use, a lot of instruments are there for protectionism and trading. So why they do it? Because if it happens that, let's say that less developing country, I started to produce clothes, but it will be expensive for them because they're not specialized in it. So since it is expensive, their cost is not low, cost is high. But developing countries, they can actually produce the item at a lower cost. So when they make the trade, the domestic companies in less developing countries, they will face a huge competition because goods are coming from other countries at cheaper price. So public will be buying the imported item from other countries. They will not buy their own product. That's the problem. So what the less developing country gonna do? They're gonna put tax. They put so much tax when they import the goods from developed countries, it becomes quite equal price to their local product. This is a trick they use so that the public will, the citizens of that country will, buyers of that country will think, oh, okay, the same product, same price. Yeah, they will be actually given a chance to actually, to their producer, to the local producers to do better. Okay, so they have like arguments here that why they do these things. Okay, the foster domestic infant industries. Infant industries mean the industry which is just started to burn slowly, to improve the nation's terms of trade, to offset distortion in the nation's domestic economy, to follow the strategic trade. Okay, this one is important to dumping. What is dumping? When a country sells, like let's say one country, they can produce wheat in abundance. Okay, they will try to sell their product in other countries lower than their cost price. Okay, that's called dumping. Okay, they will have to sell this item at lower than the cost price. So the other countries, they will be in problem. Oh my God, it's very cheap. So when they purchase something at a very cheap price, they are discouraged to produce within their own country. Politics. All right, what are the different form of protection? I told you, tariff, taxes, quotas. Okay, these are different things they apply. Like tariffs are the taxes levied on the import. That's what they mean, but there's a name. Tariffs, I say taxes, yes, import tax. This is tariff. Quotas, number, how much they can import. That's a quota they says. That how many items we gonna actually import from other countries. That's how they mean by quota. Okay, next. Problems with protections. Administrative barriers will be there. Oh, export subsidy, another one, export subsidies. So the government will say that if you can export, we'll give you subsidies. People are actually encouraged to produce more and export to other countries. That's the export subsidies they mean. Procurement policies, how they actually process the administrative barriers. So they create some, like every country tries to actually give favor to their local producers. So when the goods come up, they make lots of licensing. Australia has lots of administrative barriers. Okay, lots of like restrictions they try to put. This license, that license, these fees, those fees. They make their life hell to import the items. So what they're gonna do? Indirectly, they do these things. Okay, they're not gonna actually tell the state, "Oh, we are not gonna buy from this country." Nah, that's not a good approach to deal with trade partners. Okay, that's very aggressive approach. What they will do indirectly, they will do something. Okay, you will learn more about when you study trade, international trade. How do they do these things? Okay. The problems with protection, the cost of protection. Protection means protecting infant industries. Protection means we are meaning here the tariff, taxes, quotas, these things. Export subsidies is a huge expenses. Okay, government try to save them, protect them. Okay, by giving them subsidies. So that's the cost of production they mean here. Production is second best options, but the first option. First option is actually to produce at a lower cost. That's the first option. Sorry, but not all countries can actually produce at a lower cost. So that becomes the second options actually. Okay, and also production may allow farms to remain inefficient. You know what? I will make it easier for you, spoiling them. Okay. Effect of tariff. Tariff is a tax on imported goods. Tariff reduces the quantity of imports and moves the domestic market closer to equilibrium without trade. Gains and losses from tariff. Since the tariff raises the domestic price, like I said, that when they put such a tax, okay, that the imported items price is almost equal to the domestic product. Okay. So since the tariff raises the domestic price, domestic sellers are better off. Okay, and domestic buyers are also. Yeah, as I said that when they put the taxes, the government is earning revenues. At the same time, the buyers are actually discouraged because they have to pay more now to buy these items. Yeah, government raises revenues. Quota is the limit of quantity of that import, how much they can import. I already discussed these things. Okay, let's move on. Debate: protection versus free trade. I told you this is a big debate. Okay. Yes, we want to see their free trade so that the people can actually have a better economic activity within the countries. But at the same time, they need to actually also, they will try to actually develop their own country too in different sectors. Okay. You will see that Malaysia, Taiwan, China, like those countries, those like I won't say the third world. I will say that is actually second manufacturing countries, second world. I will say that. Okay, first world are developed countries. Manufacturing companies are actually second. So they try slowly. They're developing. You know, slowly they're developing. It's hard for them, but they're developing slowly now. I'll move very quickly. Okay, trading blocks, types of preferential trading agreements, free trade areas, ASEAN, Association of Southeast Asian Nations, then TTIP, NAFTA. Like there are different, like they make agreements to have a smooth transition of their trading. There are the various types of free trade areas they create. Like United Nations also did the free trade area, and their product can go to one country to another country within within European Union. Okay, they do these things. Yes. Like a common market, you see EU. There's no tariff between the members and common external tariff, common agricultural policies, regional policies. So all the countries together, they try to work in such a way that they have only one market. That's how they try to create it. Okay, more population will be there, more citizens are there, more consumers are there, more production will be there. They try to act like a big country, all countries together, they try to act like a big country, but they are not compromising their national sovereignty in there. Okay, but they make agreements. Through agreements, they do these things. The free movement of labor, like Brexit. I can talk about Brexit on the free movement of labor, but not today. Not today. It's not a good idea to discuss these things today. It's a huge discussion. Like it happens like lots of East European countries, their labor actually moved out of their country and went to only one specific countries, couple of specific countries like in France, Germany, England, Italy. Italian people also coming to the actually UK because they find better job in there. So only the major countries are feeling the pressure of all those people. This is one of the reason of Brexit. Okay, there are some other reasons too. Now, balance of payment. The balance of payment is a systematic record, okay, of transactions of a country with the rest of the world. So balance of payment tells you like that what are the records, which country is purchasing from which country, how much a country owes to another country. So they have, this is called the current accounts, they call it. Okay, so they have two types of accounts. They have in balance of payment, the current account and the capital account. Current accounts are the records of goods and services, export and import, income payments, interest payments, dividend, transfer, these things. Like even a company, like when you're actually subscribing to Netflix, your money is going to USA. So that's the services. Okay, when you purchase a share of, let's say, Apple Computers, so Apple Computers actually getting your money, and Apple Computers is giving you dividends to Australia. So this is the dividends you can receive. Okay. Capital items, capital goods, government capital flows, or private capital flows, which means like it will go like foreign investment. Okay. Foreign investment, they mean like capital means like they go to one country, entrepreneur from USA will come to Australia and set up their business in Australia. This is one thing they can do. They can also invest in Australian company as a shareholder. That's what they can also do. Let's go to the capital accounts. Okay. The current account has several subparts: export and import of goods, services. Like, yeah, that's what they will talk here. What are the different subcategories? Export and import of goods and services. And export are goods and services sold to foreign nations. They inject money into the nation. Export are considered to be exogenous variable. Okay, here. Exogenous variable means that which is not within the model. That's what they mean, the exogenous variables. Okay, the price of nations, goods and services export related to the rest of the world. Okay, I think I will move on very quickly on these things. Okay, another important part is the exchange rate is very important one. Relative value of nation's currency in comparison to other countries, that's what exchange rate is. Okay, this is nothing much in here. So you can see this is a snapshot of Australian balance in current account and a trend estimate, seasonally adjusted balance of goods and services. Okay, this is the millions, so they can see that how much they actually owe to other countries. Levels at the end of the period. Let's move on. Okay, so capital account refers to capital flows into and out of a nation. It has two subparts: that official government and the private sector. So government sector, they also make investment to other government. Yes, it does. Like I think Australian government has made an agreement with France to make some submarines. They made some agreement like this. So this is the government one, official government one. Private sector, let's say Australian company goes to France and make an agreement to make investment. Private sector, it will be in there. Okay. So this is the one. Balance of payment in Australia, balance of trade in goods, 15 billion. Balance of trade in services, -10. Investment income is this. So this is like how much they who owes to how much. So that's like plus and minus the fund balance in here. This balance of payments. Okay. Direct investment, portfolio investment. I think I already discussed these two. Direct investment is when one country goes to another country and make their own factory in another country and infrastructure and factories in another country. That's direct investment. Portfolio investment means they're investing in share. They are not going to make their own factory, but they will purchase the share of another Australian companies. Portfolio investment, they call these one. Financial derivatives. One country buys the bond from another countries. These things will be happening in there. Okay. Here they talk a little bit about nominal and real interest rate. They will talk in here, I believe. Yes. An exchange rate is the price of one nation's currency in terms of another nation's currency. There are two ways of quoting an exchange rate, an indirect quote and a direct quote. It refers to how much one Australian dollar is owed in terms of other countries. So they will talk like this, say USA. So it'll say 1 Australian dollar will be this much USA. But direct quote, it refers to how much one unit of foreign currency. Look, when you say one domestic, we are talking from Australian perspective. Very bad noise. Okay, we're talking about Australian perspective. We're talking about when you say one local currency is how much in foreign currency. That's called indirect. If you talk other way around, one foreign currency is equal to how much one Australian domestic currency. That's called direct quote. Okay, it depends on who is having one. If Australia is the domestic currency having one, indirect. Foreign currency having one, direct. That's the difference you have to look at. Okay. Normally in Australia, we use indirect quote. Okay. Currencies are bought and sold through foreign exchange market. Yeah, you can know these things, nothing much to talk in here. Okay. What determines the exchange rate? Okay. No government or central bank intervention. They don't do that. Floating exchange rate determined by the market demand and supply of currency. How much Australian currency the other country needs depends on that one. This is called floating exchange rate. Okay. When the exchange rate is determined by the demand and supply. I believe they give one demand and supply diagram. Okay, here it is exchange rate, okay, demand and supply. Okay, that's how they show in here. So this is the demand for Australian currency and supply Australian currency. So this is the equilibrium point. And they find out only with the 1 Australian dollar at 0.40 at this rate, 0.40 at this rate. So the Q1 quantity of Australian dollar will be the demand in the market. If Australia increases the currency like 50 cents, Q here. Okay, so demand increase, Australian demand increases. Okay, but if you think about other, like again at the same time, if you supply higher supply, so it follows exactly the same demand and supply. And this is actually about part of about floating rate they're talking here. Okay. Okay, let's see. Okay. Depreciation, appreciation, you need to understand these one. Depreciation, what is appreciation? When the local currency will be purchased at a lower price, depreciation. When the local currency will be purchased at a higher price, appreciation. Okay. It may not be good to have appreciation sometimes. I'll give you one example. For example, let's say someone likes to buy Australian red wine. Okay, someone wants to buy Australian red wine. Okay, so now let's say that India, for example. So 1 Australian dollar is equal to, let's say, 50 rupees, for example. Okay, 50 rupees. Let's talk about 50 rupees Australian. Okay, so 10 Australian dollar. So what happens? That Indian people will have to pay 500 rupees to buy one bottle of Australian. If $10 a bottle of wine, for example, okay, they have to pay 500 rupees to buy one bottle of red wine. Now, let's say Australian dollar has got appreciated. It means the price of Australian dollar has gone up. Now, let's say 60. 1 Australian dollar equal to 60 rupees. Same bottle of wine, Indian people have to pay. Again, the same $10 is Australian price. They have to pay 600 rupees. No. Same wine, $10. Because of exchange rate, now they have to pay 600 rupees, 100 rupees extra. Indian people will be discouraged to purchase Australian wine. There is too much for them. But look at Australian producers, they're receiving same $10. That's why government tries to keep the prices lower. Okay. So with government of central bank interventions, reducing short-term fluctuations. Okay. How the government actually sometimes intervene as well. Sometimes government, like Australian government, like I remember Kevin Rudd has intervened a little bit on Australian currency. When Australian dollar has gone really, really too high, he actually took some actions that, okay, we need to actually reduce our exchange rate. So he promised to reduce it, and now it is a little bit down. Before it was very high. In Kevin Rudd Gillard government, it was very hard. And Australia was really facing problem to export their minerals to other countries. That time government will take some contractionary policies. Okay, reduce the rate of inflation, reduce the consumption. That's what they will do. Support the exchange rate. They will go for raise consumptions. Okay, let me move on. Okay, exchange rates in practice. Most countries have moved to floating exchange rates over the past 30 years. So most of the countries, they go for floating rate, demand and supply. They actually apply to determine the exchange rate. International floating exchange rates are common. It's very common, like I said, that a lot of countries that do these things because they understand the policy, they understand the trick. Okay, it's a very simple trick. They understand. So to import their, not to say import, to increase their export, they need to keep their exchange rate low. So other countries can buy their goods more. Increasing volatility in exchange rates, huge growth in international financial market, abolition of capital movement controls, and speculation. So yeah, nowadays, I would like to talk about a little bit about cryptocurrency as well. New currencies coming up, different currency. It's a new currency is coming up in the market now. It's again, if you take it as another new currency, and someone is to buy the currency, like Bitcoin now has gone 50,000-60,000 US dollars. You see, one Bitcoin. Now, it's not that very regulated. And if you ask me questions, Mohammed, okay, what determines the demand and supply of these things? Okay, well, the more people will be using the Bitcoin, the more demand it will come up. In future, it might be. But currently, it's really very, very hazy market. So I don't want to talk much about these things. I tried to actually understand and learn these things. Yes, I tried it. And I went in there. I myself also tried to learn something like around $200-300 I invested and try to understand the market, what's going on in there. I found that, well, it still is not very regulated. And when it's not regulated, we don't know who controls the supply of this currency. We don't know. And this about the blockchain, block mining, lots of things are involved in here. Okay, so yeah, it's things for the future maybe, but currently, no. Australian trade indicators, you can see this is the trading indicators. Let's talk about how the data is being given. So you can see balance of payment, export, import, current account. Okay, this is the thing is interesting. Tourist arrivals, gold reserve, crude oil production, terrorism index, weapon sales. So these are the various things that determines that what will be the Australian trade indicators in here. Okay. I went too fast, I know. Okay. But I have done these things because I want to talk about exam preparation a little bit as well. That's what is my main target actually today. Okay. All right. Do you guys have any question to ask me before I move on to the exam thing? Any questions?
When do we get our assignment back?
In over this weekend. Anything else?